What if I told you that some of the wealthiest people in the world earn millions of dollars every single year without trading a single stock, without timing the market, and without lifting a finger? And what if I told you that you can use the exact same strategy, starting with almost nothing? Here is the concept that changed everything for millions of investors. When a company makes a profit, and I mean a real healthy profit, it has a choice. It can keep all that money and reinvest it into the business, or it can share a portion of that profit directly with its investors. That payment is called a dividend. Think of it as a paycheck from a company you believe in. You own a piece of that company. The company does well, they cut you a check every single quarter. Now here's what makes this extraordinary. Companies like Coca-Cola have been paying dividends since 1893. Over 130 years of sending checks to their shareholders. Through wars, through depressions, through pandemics, through every market crash you can name, they kept sending that check. Johnson & Johnson has raised its dividend, not just paid it, but actually increased it for 61 consecutive years. Think about that. Every single year, for over 6 decades, they paid their shareholders more than the year before. These companies are not just investing opportunities, they are dividend machines. Now here is where it gets genuinely remarkable, because collecting dividends as cash is nice, but reinvesting those dividends, that is where ordinary investors build extraordinary wealth. Imagine you invest $10,000 into a dividend-paying stock in 1994. The stock pays a 3% dividend yield. That is $300 in the first year. Not a lot. But instead of pocketing that $300, you buy more shares. Now you own more of the company. Next quarter, the dividend is calculated on your larger stake. You buy more shares again and again and again. This is the snowball. Small at first, almost imperceptibly slow, but as it rolls, it picks up more snow with every revolution. By the time you reach 2024, that original $10,000 investment through dividend reinvestment alone would have grown to over $400,000 in a broadly indexed dividend strategy. The math is not magic. It is compounding. Albert Einstein reportedly called compound interest the eighth wonder of the world, and nobody harnesses it more purely than the patient dividend investor. Here is a fact that most people do not know. Since 1930, 40% of the total returns of the S&P 500 have come from reinvested dividends. Not from stock price appreciation, from those quiet, steady, automatic payments, compounding year after year after year. In the world of dividend investing, there exists an elite group, the S&P 500 Dividend Aristocrats. These are companies that have not only paid a dividend, but have raised that dividend every single year for at least 25 consecutive years. Right now, there are 66 companies that qualify. Think about what it takes to grow your dividend payment every year for a quarter century. You need consistent revenue, real profits, strong competitive advantages, the kind of business model that does not crack when the economy stumbles. Procter & Gamble, Coca-Cola, Johnson & Johnson, automatic data processing. These are not glamorous names. They are not the viral stocks of the moment. They are quiet, they are steady, and they are ruthlessly effective. Studies from Ned Davis Research show that dividend-paying stocks historically outperform non-dividend-paying stocks by nearly 2% per year. Over 30 years, that 2% gap becomes the difference between retiring comfortably and retiring wealthy. Warren Buffett understands this better than anyone. Berkshire Hathaway collects approximately $6 billion per year in dividend income from its portfolio. $6 billion. And he does not need to sell a single share to collect it. The companies simply send the money. So how do you actually do this? How do you build the dividend machine? The answer is something called a DRIP, a dividend reinvestment plan. And it is simpler than it sounds. Most major brokerages today, Fidelity, Schwab, Vanguard, allow you to turn on automatic dividend reinvestment with a single click. Every time a company pays you a dividend, instead of that money sitting in your account as cash, it automatically purchases more shares. Fractional shares if necessary, zero fees, zero thought required. The machine runs itself. Here is the rule of 72. Divide 72 by your annual return rate. That tells you how many years it takes to double your money. At a 7% total return, combining stock appreciation with reinvested dividends, your money doubles every 10.3 years. At 10% total return, it doubles every 7.2 years. The math is unforgiving in the best possible way. The investor who starts at 25 and consistently reinvests dividends will, by retirement, look like a genius. They are not a genius. They simply understood one rule: let the machine compound. And here is the beautiful part. Unlike a salary, unlike trading profits, dividend income from qualified dividends is often taxed at 0 to 20%, depending on your income bracket. The government rewards patient capital. If dividend investing is this powerful, why does everyone not do it? Because our brains are wired against it. We are wired for immediate rewards. We crave the excitement of a stock that doubles in a week. We fear missing out on the next big thing. We panic when the market drops 20% and sell at exactly the wrong moment. Studies consistently show that 90% of active traders underperform a simple index strategy over 10 years. Not because the market is impossible to beat, but because we cannot manage our own emotions. The dividend investor has a secret weapon: the dividend check. When the market crashes, and it will crash, the dividend investor gets a check anyway. Coca-Cola kept paying dividends through the dot-com crash, through the 2008 financial crisis, through the COVID collapse of 2020. Every single time the market went into free fall, the dividend investor quietly collected their check and bought more shares at discount prices. This is what separates wealth builders from wealth destroyers. Not intelligence, not insider information, not timing, patience. The discipline to stay invested while everyone else is panicking. The courage to buy when others are selling. And the wisdom to let time, the most powerful force in investing, do the heavy lifting. The boring strategy always wins. And the most boring strategy of all: own great businesses, collect their profits, reinvest, repeat for decades. Here's the truth that most financial channels will not tell you. You do not need to be rich to start investing in dividends. You do not need thousands of dollars. Today, with fractional shares and zero commission brokers, you can begin with $50, $100, whatever you have. The point is not the amount. The point is the habit. The point is starting the machine. There is an old saying: the best time to plant a tree was 20 years ago. The second best time is today. The same is true for dividend investing. Every year you wait is a year of compounding you never get back. Every quarter you sit on the sideline is a dividend check that went uncollected. This channel, Market Mapped, exists to give you the knowledge that most investors spend years discovering on their own. Week after week, we break down investing concepts, analyze dividend stocks, and map the market so you can move with confidence, not fear. If this video taught you something, if the dividend snowball clicked for you today, hit subscribe, turn on notifications, because the next video is already in the works, and it might be the one that changes everything for you. The market is mapped. Now it is time to move.